Hi everyone, Brady Reynes here. It's the middle of May and I want to take a few minutes to walk through what's actually happening in this market. Depending on which screen you're looking at, you're getting two very different stories. The S&P 500 just hit new all-time highs, while at the same time the economic data tends to be telling a slightly different story. Here are 7 things worth paying attention to right now. Some are tailwinds, some are headwinds, and some are a few wild cards that we're watching pretty closely. For starters, this rally is real. Since the March 30 bottom, the S&P 500 has climbed about 18%. That move has added more than $10 trillion of market cap in just 6 weeks and brought the market to new all-time highs. This is actually the best month of the index since April of 2020. That kind of run doesn't usually happen unless there's something good going on underneath the surface. And in this case, that's true. Earnings have backed it up. 84% of the S&P 500 companies that have reported have beaten their first quarter earning estimates. So that's not nothing. This is a real rally. But the breadth is rather narrow. And here's the first complication. Only a handful of stocks are actually driving this rally at all. In fact, when the S&P 500 made its recent high earlier this week, more stocks were actually down on the day than were up. That's only possible because the S&P 500 is weighted towards the largest companies. So if the big boys are going up, it can carry the market higher even if most stocks aren't participating. Is this a bad thing? I mean, it isn't great. It's typically a sign of weakness in the broader market. The last 2 times that we've seen breadth this thin was in March of 2000 and in the spring of 99. And we both know how those stories ended up. That's not a reason to sell, but it is a reason to pay attention rather closely, which is exactly what we're doing. Another interesting headline recently came out about inflation. The April CPI number was 3.8%. Now that's the highest reading since May of 2023. Wholesale inflation, known as PPI, just printed 6%. Now both of those numbers are rather uncomfortable, but the main driver for each is energy. Gasoline prices are up 28% year over year. It actually feels like more than that. Airline fares are up 20% as well. The Iran conflict, which started in late February, has been working its way through global supply chains ever since. Cumulatively, since 2020, inflation is running at about 30%. In other words, you'd need about $130 today to purchase what $100 bought 5 years ago. That's the real story behind why every grocery bill doesn't feel quite right. The bond market has also taken notice. Interest rates typically rise when inflation rises. That happens because the bond market anticipates higher interest rates are on the way. Last week's 30-year Treasury auction cleared 5%. That's the first time that's happened since 2007. This filters into mortgages and car loans and corporate borrowing costs and all those things that mean costs are rising. The bond market typically does this because when inflation is elevated, there's additional pressure on the Federal Reserve to raise rates. All of these factors have led to a weaker consumer. And this may be the most interesting point of all. According to the New York Fed's first quarter report released just this week, 13.1% of all U.S. credit card balances are now 90 days or more delinquent. That's the highest reading since 2011. Believe it or not, auto loan delinquencies are at an all-time high. Student loan delinquencies are back near 10%. So while the stock market may be rallying, the household balance sheet at the bottom of the income ladder is saying something entirely different. Both can be true at once, but the gap is widening, and that doesn't necessarily bode well for long-term economic and stock market performance. Kevin Warsh was confirmed earlier this week in the Senate. It was the closest Fed chair vote in modern history. His first official Fed meeting is June 16th and 17th. It'll be really interesting to watch and see how that plays out. Warsh has said in the past that there's room to cut rates, but with inflation reaccelerating and the 30-year note at 5%, the path forward is going to be one of the most watched stories in the market for the rest of the year. Warsh definitely has his work cut out for him. There's political pressure to cut, but the economy tends to be telling a different story. And then, of course, there's also the geopolitical backdrop. There are 2 fronts worth watching right now. The Strait of Hormuz continues to be blocked. We're already seeing that show up in the inflation data. This week, President Trump and President Xi held a two-day summit in Beijing, where Xi publicly called Taiwan the most important issue in the U.S.-China relationships. We'll talk more about Taiwan in future videos and the possible implications if China moves to take Taiwan, but rest assured it's a developing story with big implications. Stocks are making new all-time highs, earnings are strong, and investors are optimistic, but the risks are real also. Together, that makes a case for just staying invested but not chasing these returns. And we're ready to make changes if and when the market dictates. Risk management isn't about predicting the next move, it's about putting rules in place to reduce risk if and when the time comes. Now, if any of this raises questions about your portfolio or your plan, let's talk. As always, we are grateful for your continued confidence and trust. Thanks so much for watching and have a great day.